Right now, we want to get over to Steve Liesman. He is at the Chicago Fed Economic Outlook Symposium this week with Bank President Austan Goolsbee. Steve, take it away.
Hey, good morning, Becky, and thank you. Just before I go, I start here. Jeff Schmidt, the Kansas City Fed president, another dissenter, out with a statement at this hour saying the reason he dissented, inflation is too high, the economy showed continued momentum, and the labor market, he says, is largely imbalanced. So we could talk about all that with Austan Goolsbee, professor, president, and now dissenter. That's another moniker we have for you now.
Indeed. Welcome, though, Steve, to the beating heart of the Federal Reserve System.
Are you kidding me? What a beautiful place. So let's talk about the dissent and why you decided. I guess this is your last vote until the next cycle comes around for you. Why was it important for you to vote against the rate cut?
Well, look, Steve, you know I've been saying for months I'm pretty optimistic that for 2026 rates will be able to be a fair bit lower than they are today. But I've just been uncomfortable front-loading too many rate cuts and assuming that what we've seen in inflation be transitory. It's all amplified by the data being shut down. And so I just felt that we ought to wait, that we don't lose a lot, we don't take a lot of extra risk, in my view, to just wait to Q1 2026 and make sure that we're back on path to 2% inflation.
The big pushback here, though, comes from the job market data that we do have, which suggests that the labor market is weakening pretty substantially.
I don't know that I see it exactly the same way, in that most of the measures of the job market have been pretty stable. And the chance that things in the job market would fall apart rapidly within 1 to 2 months before we would revisit this again feel relatively low. We're in this environment where anything measured in rates, like the unemployment rate, the layoff rate, the vacancy rate, et cetera, those have shown stability. Where you've seen the number fall off has been raw aggregate monthly payroll, but that's the one with the biggest question mark because of immigration, because of retirements. We don't know what the break even is. So as we look at an environment that's been characterized, I would say, as this low hiring, low firing,
right,
it's worth remembering that's not what the business cycle looks like. You have low hiring, high layoffs, or you have low layoffs, high hiring. For both to be low at the same time, to me, that says more like uncertainty than it does slowdown.
So it could pick up, you think, on the backside. Before you answer that, though, you have to deal. I'd like you to answer this issue with Fed Chair Powell, who said that when you figure in what could be revisions, the really substantial revisions to the job numbers, you could be minus now.
You could. The only thing is we don't know what the break even is on the monthly payroll. And we saw in 2023 and in 2024 on the inverse side, we're getting these big numbers. And there were a number of people saying, how could the economy not be overheating if we're getting 150, 180,000 jobs a month? And the answer was, that's a false reading of where you are in the business cycle because the break even was higher. Right. So I think looking at these rates is a more effective way to figure out where you are in the business cycle. And they've been basically stable, cooling mildly. The hiring rate is low, but the layoff rate is also low.
But they're just putting up, Austan, to your right there. There's the unemployment rate. It's ticking up. You were at 4. When was that? Back the beginning of the year. And then, guys, we're looking at it right now. It ticks up to 440, 40 basis points. Okay. Who says you know where this stops?
We don't, and that's my only point. Like I say, I am not hawkish on rates for next year. I think that we make progress and that by the end of next year, if you look at the dot plot, I'm one of the most optimistic folks about how rates can go down in the coming year. I'm just uncomfortable with front-loading the rate cuts, assuming all of the inflation that we've seen be transitory. There's no way around. We've been 4.5 years above the inflation target. And the last 6 months have shown no progress. And right before the lights went out, You saw a couple of relatively disturbing readings on services inflation. I just want to make sure that if we believe that this is transitory, let's not just put all our eggs in the
So I have not been
basket.
sent here from New York, Austin, to get you with the program. But let me tell you what the program is.
Okay.
The program is you got these tariffs on. They're coming off next year. Inflation's going to fall. Don't you worry your pretty little head about inflation.
That's what I want. I want to not be worried about
Is
inflation.
that what's wrong with that theory?
There's nothing wrong with the theory. I
Now.
just want some evidence that that is in fact happening, because that's disturbingly sounds like exactly the argument of 2021. It's about to go away.
Transitory.
Team transitory. And there were many of us, private sector, I wasn't in the Fed then, but Fed, private sector, academics, buying that logic. If you look at the forecast, if you believe that the inflation is coming primarily from tariffs and it's going to roll off and be transitory, that is supposed to start showing up in the data in Q1 of 2026. As long as we get some data showing that, as I say, I'm one of the most optimistic people for 1 year from now, how far rates
Where are you
go
1 year
down.
from now?
Look, I don't. The dots are anonymous for a reason, but I'm more than the median
Okay.
in optimism.
For 26.
For 26, for the end of 26.
Okay. So one other argument that's out there, and I asked Chair Powell about this, was this idea that, hey, you have this, it was interesting, they raised the growth forecast. They didn't really lower the unemployment rate, and they lowered the inflation rate a little bit. Tells me that there's a productivity thing happening there.
Well, look, we've been noting the productivity, that there's been strong productivity growth, but I took from the forecast, not just coming out of the dot plot, but if you look at the private sector too, they view the unemployment rate in the coming year to not be much higher than it is right now, that it's
true.
pretty stable. And so that's why I just want to get evidence that inflation is going to be temporary. Because as I say, before the lights went out and we stopped getting official data, there were some disturbing readings on services. And as you know, services is historically a much more persistent type of inflation and is not likely caused by tariffs. So let's just make sure when the lights go out, let's just wait a second. I always say I have only ever aspired to be one of the data dogs. And the first rule of the data dogs is there's a time for walking and a time for sniffing. And we need to figure out the difference of those. And when there's no data, that's the time for sniffing.
Let's leave the building and the ivory tower and talk about what we're hearing from the American public, which is that they're really having trouble with prices right now. How does that inform
look,
you're thinking about policy?
As you know, I travel around and talk to everybody here, heart of the Midwest. The district in Chicago is Iowa, Indiana, Michigan, Wisconsin, Illinois. At the least, prices are one of the main factors, concerns that both businesses and consumers have about the economy right now. So that's why we can't ignore that inflation's been above the target for 4.5 years and it's rising. Let's just I do have some confidence that it will come down, and a year from now, rates can be lower. I'm just uneasy with front loading because of that.
Becky, go ahead.
First of all, Austan, you never fail to disappoint. I love your analogy. I just wonder, what are the dogs
I never
sniffing?
fail to disappoint.
You never disappoint, I should say. You never fail to keep us interested. I misspoke. You never fail to impress. That's right. What are the dogs sniffing, first of all? Second of all,
what are the dogs sniffing?
Yeah. Where?
Look, sniff the data. Sniff everything that hits the floor. It might be food. You know, that's the other rule.
That too. Okay, let's talk a little bit more broadly about the Fed. You all made the early move to reappoint a lot of these Fed presidents yesterday, and that kind of cut off some concern people had about whether the Trump administration was going to get more hands-on with moving the Fed around, maybe trying to replace some of the presidents that are there. Do you feel like the Fed is trying to prepare for an onslaught coming from the Trump administration?
I don't think so. I've been on the Fed on the FOMC for about 3 years, and I'm struck, and you can see in the minutes, and you'll see when the transcripts come out, and you can read word for word, the way the interest rate decisions are made have nothing to do with anything other than the economic outlook and the economic data. People take the job extremely seriously. It's not a partisan, you're out of the elections business. That people take the job seriously, that's fundamental to Fed independence. And I think everybody understands how important Fed independence is.
Austan, you told me before we went on air that, in fact, and I may have this wrong yesterday, the vote took place just at the same time it always takes place. It was when it was announced earlier.
I think that's true.
Okay.
My understanding, I wasn't here 5 years ago,
right.
But the way I had heard it, there was a vote in December. It was announced in January, and the official appointment is at the March 1.
I mean, there's no doubt it was sort of an end run on some possible, you don't have to say this, but it seems like an end run on some possible influencing or changing that the president might have had if he had the majority on the Federal Reserve Board. But if it's the same timing, then it's only a matter of announcing it rather than actually.
That's my impression. Okay. I know the process is a very robust process. We had to submit a lot of documents. What have you done? What are your successes? What are your weaknesses? How each of the banks has been operating.
And did you say your problem is you care too much? Let's talk about the Fed balance sheet, which seems to be influencing markets these days. You guys made a decision, as far as I can tell, earlier than the market expected to come back into the market and larger than expected. Why isn't this new $40 billion of purchase of bills? Why is that not QE?
Why is it? This is a technical adjustment. It's not QE because the intention of doing this is just to allow rate control. It's not to try to influence monetary policy. We're not at the lower bound. You'll remember the QE was about trying to do monetary policy when you can't adjust the interest rate. And this has nothing to do.
But you are growing the balance sheet, right?
We are growing the balance sheet, but as I say, the balance sheet, when you're operating in an ample reserves regime, is supposed to be a share of something, a share of bank deposits, a share of GDP. So over time, it's got to be growing. The timing of that, in this case, I think is just a technical adjustment. You've seen, if you go look in repo markets, felt like we're getting pretty close to the point where they're not ample. And if reserves are not ample, we're not going to be able to set the rates how we need to set them.
Mike Santoli has a question.
Yeah, Austan, a couple times you've referred to some of the inflation data we got before the data stopped as disturbing on services inflation, things like that. Have you taken any comfort in the market signals about how it feels about inflation, whether it's market implied inflation expectations or even longer term Treasury yields, which have not really broken out of a range?
Yeah, I take a little comfort that it's an important issue to raise, that these market-based measures of inflation expectations, let's call it in the near term, have looked better than the survey measures when they ask consumers. And I do take some comfort in that. And that's part of why, as I say, I'm optimistic that a year from now rates can be a fair bit lower than where they are right now if the path of inflation goes how we want it to go and how people anticipate, that it will be transitory, that what we've seen will go up and then come down. And when it's supposed to start coming down, it's supposed to be detectable, observable in Q1 of 2026. So I don't view that there's that high of a risk of just waiting a very little bit to make sure that inflation is starting to come down.
Austan, we have to go, but a real quick question because we're going to get a lot of data next week. What's your sort of upper tolerance for the unemployment rate? Where does it start to get worrisome to you?
Look, it's always worrisome. whenever it's rising.
Yeah.
It's been rising a little bit. It's been rising gradually. If the unemployment rate is 4.5 or under and stays there stably, as long as it's coupled with some of these other rates, the vacancy rate, the hiring rate, the layoff rate, if those show stability, we're not in the space that I'm.
But Waller says that hey, the unemployment rate or the job market, the way it looks now, is not going to be a source of inflation. So that's the reason why he's not worried about it.
You know, I'm only allowed to speak for my own views.
Yeah, I'm just throwing out another view
I'm friends with Governor Waller, and I respect him quite a lot.
Yeah.
So when he says things, I go analyze it. My read of the data, and we've got Chicago Fed research that backs it up, is wages are stickier than prices. So when things happen in the economy, you tend to see the prices go up first or go down first, and then that is followed by the wages. Wages are not a great leading indicator of prices. So I'm a little wary of over concluding from wage growth what you think is going to happen.